Hello everyone, welcome to today's video. Today we are going to describe classifications of assets and markets. Types of assets. Financial assets include securities, which are stocks and bonds. They also include derivative contracts and currencies. Real assets includes real estates, which means properties. It includes private land or offices or buildings or the land itself, equipment, commodities, and other physical assets. Financial securities can be classified as debt or equity. Debt securities are promises to repay borrowed funds. Equity securities represent ownership positions. Debt securities are generally issued by corporations and governments in forms of treasury bills or bonds. Publicly traded securities are traded on exchanges or through security dealers and are subject to regulatory oversight, such as in India, SEBI regulates the stock exchange. Securities that are not traded in public markets are referred to as private securities. Private securities are often illiquid and not subject to regulation. They are illiquid because there is no regulation in that kind of securities. Derivative contracts Derivative contracts have values that depend on the values of other assets. That means the value of that particular derivative contract is ascertained or is derived from the particular contract. Financial derivatives contracts are based on equities, equity indexes, debt indexes, or other financial contracts. Physical derivative contracts derive their value from the values of physical assets such as gold, oil, and wheat. Moving on to the next slide or next topic, we have types of markets. The primary market is the market for newly issued securities. Subsequent sales of securities are said to occur in this market. Usually, IPO or initial public offering is included in primary market because the security is issued for the first time to the public. Money market referred to the markets for debt securities with maturities of 1 year or less than that. Capital markets refer to markets for longer term debt securities and equity securities that have no specific maturity date unless and until the company goes bankrupt and the company is delisted on the exchange. Traditional investment markets refer to those for debt and equity. Alternative markets refer to those for hedge funds, commodities, real estates, collectibles, gemstones, leases, and equipment. Anything which is other than money market, primary market, capital market, or traditional market are included in alternative markets. Alternative assets are often more difficult to value. They are also illiquid and require investors' due diligence, which means investors needs to be cautious before investing into those assets and therefore often sell at discount. That's all for today's video. Thank you for watching.